Data from the National Pension Commission shows that total assets under management of the pension fund administrators rose by 6.3% year-to-date to 14.3 trillion naira. This is as of June the 30th this year. Of this figure, investments in federal government instruments dominated with 63.1%. Pabina Yinkere, Chief Investment Officer at Sigma Pensions, joins me to discuss what's driving the increase in investments by the PFAs. Thank you, Pabina, for taking the time out to join us today. What do you make of this latest figure? We know that, of course, there's been that steady growth in assets under management. But what do we need to know about how this increase is happening?
Thank you for having me, Esther. As you know, the industry continues to grow significantly. Today, pension funds account for the largest pool of investable assets in our market. This is from almost nothing that markets could access about 17 years ago. So the industry has seen tremendous growth. That growth has been driven by a combination of contributions, new accounts, and investment returns. For the year 2022, in the first half, the investment returns have been better than they were in the prior year. However, they still remain, they could do better given where inflation is at the moment. So primarily, most of the growth was driven by investment return during the half. Equities in the first half performed very well, returning 21% against all odds. The fixed income market, not so good, but we've seen interest rates creep up slightly. So that is also helping improve the yield on pension fund portfolios today. So I say that growth was primarily driven by more investment return than contributions.
Now, quickly staying with the investment returns, I know that for pension funds, obviously government securities, fixed incomes, treasuries are usually the safest bet. And of course, that's why we have the equities segment, having a much lower share. But with the stellar performance, in quote, of equities, does this make a case for perhaps an increase of the share of equities, or the PFAs will still like to play it safe and leave it where it is right now?
I think the plan for now is to still play safe, particularly when you consider what's happening in the global context. Global central banks are increasing interest rates. The Central Bank of Nigeria has also increased interest rates as well. It all just points to the fact that interest rates should be higher. And in a world where interest rates are higher, equities become less attractive. However, given how the market has performed and given the investor profiling of our market these days, where foreign portfolio investors are less of a play in the market, we think the downside to the equity market is not so much. So I would expect that the allocation to equities doesn't really change much from here on into the end of the year.
Now, for new accounts, and just looking at the headline figure, 14.3 trillion, while this is a good number, but just looking at the share size of the Nigerian population, one could argue that this number could actually be significantly higher in terms of the number of people, or the categories of people who are part of this scheme. What can we do to change this? What can we take a leaf from an economy with similar indicators such as ours, who perhaps running the same contributory scheme as Nigeria, where we can take one or two examples from?
You're absolutely correct. Pension penetration in our market today is only just scratching the surface, if you would ask me. We have just about 9 million pension accounts compared to an addressable working market of maybe around 60 million. So it shows that the penetration is still very small. There's a lot of room for growth. I think the closest market we can benchmark when we look at Nigerian pension market is perhaps Chile. And in Chile, we have seen tremendous growth when they adopted the CPS. What can help our market to deepen this pension penetration is, I think, is more a macro issue. We need to create jobs. We need to get more private sector-led activities in the economy so that can drive overall enrollment. If you look at our pension scheme today, the federal government and state governments account for a large part of the pension accounts that are registered today. We need to see more private sector pension accounts being opened. If you recall, the micro pension fund, which is a fund set up to address the informal sector was released just about 2 years ago. And the growth in that space has been, whilst fantastic, I think we could still do more. Today we have 80,000 micro pension accounts. I think we should be talking about tens of millions of micro pension accounts in our market today. So there's a lot of room for growth in the pension industry. The industry is still young, just 17 years old. With time, we can deepen that penetration, but of course, it has to be driven by a lot of economic growth. It has to be driven by a lot of jobs being created. Those are the factors that will drive a much deeper pension market for Nigeria.
I mean, I was just thinking about perhaps legislation. Can that also be an aspect that could unlock more growth, or would that be something that is forced? Because if people do not have jobs, obviously they cannot have, pay pensions. But we do know that some states are not, on board the scheme also, even though obviously it's a good idea for them to do so.
Yeah, you can only legislate to an extent. For example, all federal government, parastatals, departments, and ministries are on the scheme. However, for the state government, you cannot legislate for the state government. So it's driven by, in as much as one would desire that these states be part of the scheme, it's difficult to enforce it. So we don't see a lot of state adoption of the pension scheme. So, but I think what is more important, if the industry continues to grow, states are able to get their finances intact, and they see, because one of the attraction for a state being involved in the pension scheme is that it gives you the opportunity to be able to come into the capital market and raise money from these pension funds, right? So with that kind of incentive in place, I think it creates an avenue where states, if they can get their acts right, should benefit a lot more from having themselves in the pension scheme today.